The Subcommittee on Capital Markets will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Solutions in Search of a Problem, Chair Gensler's Equity Market Structure Reforms. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And before I recognize myself for 5 minutes, I want to take a point of personal privilege and wish the gentleman from Georgia, Mr. Scott, a very happy birthday.
Look at that.
Well, isn't that nice and gracious of you? Thank you very much.
One of my dearest friends.
Yes,
On
indeed.
both sides of the aisle. Happy birthday, Mr. Scott.
Thank you.
I now recognize myself for 5 minutes to give an opening statement. Today's hearing will examine equity market structure reforms put forward by Securities and Exchange Commission, SEC, Chairman Gensler, that will reshape American equity markets. To the casual observer tuning in today, that might sound like a sensible endeavor for a regulator, especially if the regulator identified clear examples of problems and crises in our markets, and if the regulator clearly demonstrated how the reforms would result in better outcomes for market participants. Unfortunately, those critical elements are missing from Chair Gensler's proposed overhaul of our equity market structure. America's capital markets are the deepest and most liquid in the world. Companies from all over the world choose to go public in the United States and list on American exchanges. Almost 12 billion shares trade each and every day in the United States through American exchange markets alone. Over the past 20 years, the U.S. equities markets have changed dramatically and for the better, becoming more competitive, efficient, and accessible for everyday American investors. Since the introduction of zero-commission trading, which has become the norm since 2019, retail trading has seen record growth and now accounts for between 10 to 20% of trading volume in the U.S. Over 100 million Americans rely on our equities markets for their financial security, stability, and retirement. Nevertheless, in December of 2022, Chair Gensler and the SEC proposed 4 interconnected equity market structure proposals that would upend our current market structure and harm millions of retail investors. Then, in October of 2023, the SEC proposed yet another significant equity market structure rule on volume-based pricing. For those of you who keep count, that's 5 sweeping equity market structure proposals from the SEC in the span of less than a year. In March of 2024, the SEC unanimously adopted one of those proposals, amendments to update Rule 605 disclosures and capture more useful information on order execution. You might be saying to yourself, more useful disclosures and better data on equity quality sounds like a smart place for the SEC to start, and I would agree with you. Taking that improved data from Rule 605 updates, analyzing it, and letting your findings inform which additional reforms are necessary or whether any reforms are necessary would be the prudent approach for the SEC. Unfortunately, Chair Gensler disagrees, as he is intent on advancing the remaining 4 proposals without analyzing the improved data and potential findings from Rule 605. You might be saying to yourself, well, then surely the SEC has identified clear problems or failures these reforms will address, or they can produce economic analyses demonstrating that market participants will unmistakably be better off because of these reforms. Well, I'm sorry to disappoint you again. Throughout its economic analyses of remaining proposals, the SEC explicitly admits numerous times that the economic effects of the proposals are unknowable. Not to mention the SEC's economic analyses also inappropriately rely on data the SEC itself concedes is outdated and inaccurate. Case in point, to justify 3 of the remaining 4 proposals, the SEC relies on trade execution quality data from Rule 605 reports, despite SEC staff admitting that current Rule 605 reports offer limited usefulness. After all, updating and improving Rule 605 to yield more useful data is what the SEC recently approved. Just 3 months ago, we have no findings. Ensuring that the SEC acts prudently and only issues regulations that are absolutely necessary after providing clear evidence of problems and analyses demonstrating the desired positive impacts shouldn't be a partisan issue. Millions of everyday Americans depend on the success of our equity markets for their financial securities. These Americans are looking to us to ensure that Chair Gensler doesn't use a wrecking ball when perhaps a scalpel would be more appropriate. I want to thank our witnesses for their testimony, and I look forward to our discussion. The Chair now recognizes the ranking member of the Subcommittee on Capital Markets, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
We should mourn the Supreme Court's ruling of today that will make it much more difficult for the SEC to enforce the rules that keep our capital markets the safest in the world. This is the worst Supreme Court decision since yesterday, when the Supreme Court Supreme Court legalized corruption by saying that a mayor could give a $1 million contract and take $13,000 in cash, and that's just fine as long as you can't prove the quid pro quo. So I would advise corrupted officials around this country, simply don't put the quid pro quo in writing. You will be fine with this Supreme Court. I'm glad to see the SEC is doing its job. I've been here for 28 years and heard many hearings where they get criticized for not doing enough. They are discharging the mandates we've given them by statute, particularly Dodd-Frank. When it comes to our markets, there is the commission that you pay, and we tell investors, oh, 0 commission, and then there's the spread. Investors are not protected unless they're getting not just best execution, but the most enhanced best execution that they can get. The SEC has identified $1.5 billion per year that investors are losing because while they're getting something that's called best execution in the securities world, it's not enhanced best execution. And I'd point out that being able to tell people that it's 0 cost when it isn't 0 cost is a way to encourage the gamification and day trading that is unfortunately part of our capital markets. I am pleased to see the SEC is moving in the right direction, and I hope they will work with FINRA to best work to make sure that investors know not only what is the commission, but what was the spread and whether a better execution could have been available to them. I'll point out that 90% of the retail orders are going to wholesalers. We should, as a government, do everything possible not to encourage the use of these wholesalers, because when instead that trade goes to an exchange, we get the public is informed, we have the consolidated audit trail, and this is critical to the effective capital markets. When it comes to crypto, it was in 2022 in this room that I told the SEC that if crypto was an unregistered security, that the crypto exchanges were trading in unregistered security. They have finally moved in that direction, as well they should. Unfortunately, Congress, the House, moved in the wrong direction by passing FIT 21, which not only has an effect on the crypto world, but offers an opportunity to take traditional stocks and bonds and tokenize them and avoid the whole securities regulation process. It is the passage of FIT 21 that causes me to say something that I never say, which is thank God for the United States Senate. When it comes to trading, remember that spread is very important. The spreads that are available on big stocks like Apple and Amazon are roughly 1/10 what crypto traders are paying for Bitcoin and Ethereum. So we have efficient markets for major stocks, and we have fleece the investor margins or spreads when it comes to crypto. And finally, one thing the SEC hasn't yet dealt with is how the exchanges have totally insulated themselves from liability when they make mistakes, thus shifting the costs of that liability. And I refer to, I think it was the Facebook offering of a decade ago, shifting that liability onto the practical effect of the liability onto the brokers. And I look forward to exploring that as well, and I yield back.
I'm now going to move on to witness introductions and testimony. We will certainly hear from the ranking member of the full committee when she arrives. I want to tell all members and our witnesses that we're going to have a pretty hard gavel because we've got votes that are coming up in less than an hour and a half, and I want to move through as expeditiously as possible. But today, we'd like to welcome the testimony of Jonathan Brogard. Professor Brogard is professor at David Eckley School of Business at the University of Utah. Kevin Kennedy, Mr. Kennedy, is Executive Vice President and Head of the North American Market Services at NASDAQ, testifying on behalf of Equity Markets Association. Ari Rubenstein. Mr. Rubenstein is co-founder and Chief Executive Officer of Global Trading Systems, GTS. Justin Schack. Mr. Schack is partner and head of market structure at Rosenblatt Securities. And then John Ramsey. Mr. Ramsey is Chief Market Policy Officer at IEX. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. And without objection, each of your written statements will be made part of the record. Professor Brogard, you are now recognized for 5 minutes for your remarks.
Chair Wagner, Ranking Member Sherman, and distinguished members of the Capital Markets Subcommittee. Thank you for this opportunity to come before you to discuss the SEC's proposed equity market structure reforms. It is an honor to be afforded this opportunity to testify today. I am deeply appreciative of this committee's work to safeguard our financial markets and economy. In this testimony, I hope to assist the subcommittee's deliberations into the SEC's proposed overhaul of equity market structure. The importance of this hearing cannot be overstated. The SEC's 4 market reform proposals seek to implement a dramatic transformation in the core infrastructure that underpins how securities are traded. It covers several key aspects, but perhaps most importantly, it seeks to reshape how everyday retailer investors experience securities trading. Our equity market is the global leader in terms of market liquidity, market quality, and efficiency. This status is not a given. Congress and the SEC, working alongside market participants, have invested in rulemaking and reform over decades that have introduced competition, broadened investor choice, and reduced the costs of trading for institutional and retail investors. For example, because of Reg NMS and Reg ATS, the market ecosystem has 16 exchanges and 30 trading systems that interact as a part of a dynamic and evolving ecosystem that is unparalleled. As such, any transformative reform project must be approached with caution and its costs and benefits be well understood. This is especially true for measures seeking to reshape the retail trading experience, as the proposed reforms seek to do in a major way. The SEC's proposed reforms directly target wholesalers, firms that provide brokerage firms access to a sophisticated and competitive system of handling investor orders. These proposals would require individual brokerage firms to internalize these activities. In my view, such an outcome could damage the quality and increase the cost of the retail investor experience. Wholesalers today enjoy economies of scale. They have accumulated experience and expertise. They are also well connected to infrastructure, capable of buying and managing data from across exchanges and other platforms, and subsequently deliver fast and reliable execution at low cost to investors. Importantly, brokerage firms regularly monitor the execution quality of the different wholesalers and reallocate order flow based on performance. This creates competition across wholesalers and aligns wholesalers' incentives with those of retail customers. The degree to which wholesalers compete with each other to offer improved execution quality should not be overlooked. Our equity markets are valued at over $40 trillion and represent 40% of global equity market capitalization. The U.S. equity market stands ahead of its competitors in powering efficient capital formation, risk management, and investor welfare. Over the last 2 decades, the U.S. equity market has radically transformed its market structure to deliver an extraordinary slate of economic gains across the board, supporting individuals in building their retirement accounts and expanding access to capital markets to a broad swath of the population. Of the 4 proposals the SEC set forth regarding equity market structure in December 2022, the amended Rule 605 proposal has been adopted. The amended Rule 605 mandates detailed public disclosure of order execution quality by market centers, representing a significant enhancement in the transparency and availability of stock trading practices. I applaud this move by the SEC. It will provide new and important data to academics, regulators, industry participants, and the public about how markets are functioning. As an academic, I'm excited to see what new insights we will be able to glean from this data that can be used to further understand and enhance our markets. Chair Wagner, Ranking Member Sherman, and distinguished members of the Capital Markets Subcommittee, the SEC has proposed an expensive and untested redesign of equity market structure without first demonstrating a viable and credible economic case for doing so. Ensuring healthy and diverse retail participation represents a delicate balancing act that regulators, policymakers, and market participants have succeeded in improving over time. Retail investors have never had it better. The discussion around retail market quality is focused around not dollars per share, not dimes per share. It's focused around pennies and sub-pennies per share. It is of the utmost importance that regulators do not enact rules that might reverse these gains. Thank you.
Gentleman yields back. The chair now recognizes Mr. Kennedy for 5 minutes to give your oral remarks.
Thank you, Chairman Wagner and Ranking Member Sherman. It is an honor to testify this afternoon for you and your esteemed colleagues. The U.S. equity markets are the envy of the world. Any reforms of equity market structure, no matter how well intended, must be thoughtful and rely on strong supporting data and a full understanding that consequences will follow. NASDAQ's unique role as a listings venue for public companies that brings IPOs to the marketplace distinguishes our point of view here. While other trading centers simply operate order books that seek to match buyer and seller, we facilitate the public company model and foster U.S. IPO competitiveness. We care about the trading environment for all companies, emerging growth companies, the community bank, the biotech startup, and the local manufacturer, where your constituents invest in their 401ks and save for houses and college. Their investment capital supports jobs and growth in every congressional district. Public companies rely on the capital markets to attract investors and to establish a stable valuation for the price of their stock, and they use that valuation to grow, hire, and compete. With this in mind, and though we share some of the SEC's reform objectives, they simply propose too much, too quickly, to fix an already competitive market that is not broken. Among our primary concerns is that they will harm the transparent, accessible, and publicly displayed lit markets. The past few years, lit markets have faced significant erosion due to regulatory disadvantages relative to dark markets affecting the quality and quantity of the orders we receive. This is concerning because quotes displayed publicly on lit markets like NASDAQ are used exclusively to calculate the national best bid and offer, the MBBO, the best available price to buy and sell stocks across the equity markets during the trading day. We fear the net effects will undermine the integrity and reliability of the MBBO as the true best available price for stocks, rendering it more difficult and expensive for Americans to invest in our markets. NASDAQ supports, in concept, the need to refine the minimum increment in which stocks can be quoted. But the SEC proposal misses the mark. Most of the industry suggests that the SEC adopt the simple approach of adding one tick size below 1 cent at a half penny. We also support harmonizing the minimum increment in which stock orders may be executed across both exchanges and non-exchanges. As said previously, exchanges suffer a regulatory disadvantage relative to non-exchanges insofar as exchanges cannot price or execute orders in increments as fine as others. With respect to the SEC's cap on fees the exchanges charge to access liquidity, NASDAQ is strongly opposed. It lowers the cap far beyond what is needed for tick reform, slashing the access fee cap more than 80% in some cases, as a means of addressing ill-founded concerns about exchanges' payment of liquidity rebates. This proposal will weaken the MVBO and the incentives that encourage better liquidity and tight spreads. There's simply no evidence or data suggesting rebates represent harmful conflicts of interest, and there's ample evidence that rebates benefit the markets by strengthening the MVBO. We appreciate the Commission's desire that retail orders are exposed to greater competition, but their proposal lacks the data to justify the solution, and the SEC risks too much by solely focusing on novel and untested auctions. They should instead permit exchanges and others to innovate their own solutions. NASDAQ supported the 605 reforms. However, that data should underpin any justification for the Commission's other market structure proposals. We urge the SEC to slow down until they can collect the enhanced 605 data before it determines whether and how to proceed with these other market structure proposals. The volume-based pricing proposal upends practices critical to the fabric of the markets and ignores its interplay with other pending market structure proposals, several that address the same problems. The SEC's assertion is inaccurate that volume-based pricing hurts small and medium-sized brokers from competing with larger brokers. Competition among brokers depends on factors unrelated to exchange fees, and there is no evidence that tiered pricing unduly influences broker routing choices. The proposal is arbitrary and fails to account for off-exchange markets where volume-based pricing would be unaffected. Finally, volume-based pricing does not inhibit small exchanges from competing with large ones. Exchange competition is fierce, with 16 exchanges and counting. On the SEC's best execution role, they should proceed carefully and listen to industry feedback, as the proposal has too many questions unanswered and fails to indicate how best execution enforcement will differ from FINRA and MSRB. In closing, NASDAQ is open to refinements to U.S. equities market structure based on data-driven and incremental changes. We look forward to working with the SEC, with Congress, and broader trading environment stakeholders to ensure that the U.S. equities markets remain the most liquid and robust markets in the world. Thank you again for the opportunity to testify.
Thank you, Mr. Kennedy. Chair now recognizes Mr. Rubenstein for 5 minutes to give your oral remarks.
Chair Wagner, Ranking Member Sherman, and distinguished members of the subcommittee, thank you for the opportunity to testify today. My name is Ari Rubenstein, and I'm the CEO of GTS, a global electronic market-making firm. In my testimony today, I'll address several key areas crucial to understanding and maintaining the robustness of our U.S. equity markets. These include the strength of the U.S. equity markets, the importance of empirical data in regulating those markets, the interconnectedness of the SEC's current equity market structure proposals, and finally, concerns with those proposals. U.S. equity markets are the cornerstone of global finance. Our markets are the largest, best performing, and the most liquid, and have a certainty of execution that is fundamental to efficient capital formation and price discovery. With all-time high retail investor participation and reduced commission rates, the retail experience has never been better. Given the status of U.S. equity markets as the global standard, our starting point for any potential changes needs to be to do no harm. The strength of our markets prompts a critical question. How did we achieve all this? Market makers like GTS play a crucial role by standing ready to both buy and sell at all times, and taking on those associated market risks, which facilitates transactions through immediate liquidity. Liquidity in our markets is highly dependent on and reactive to market structure. That's why any regulatory changes must be data-driven. A data-driven approach starts by first identifying market structure problems and goals, then assessing credible data and economic analysis and alternatives, all with an eye toward ensuring that any changes, even if well-intended, are justified and do not detract from the strong markets that regulators and market participants alike have worked so hard to achieve. Unfortunately, proper analysis of the SEC's market structure proposals is all but impossible because the SEC has set forth proposals that are interconnected and overlapping with no analysis of cumulative costs and benefits, combined effects of the proposals together, or the potential for unintended consequences. Without adequate evaluation of the cumulative effects of these proposals, any single proposal could significantly alter markets and incentive structures, potentially making additional rules unnecessary or changing the market dynamics that other proposals seek to address. Implementing these proposals hastily could have severe consequences for U.S. capital markets. Turning now to the SEC's Regulation NMS proposal aimed at modifying tick sizes. Despite some disagreement among stakeholders about how extensive any problem may be and the proposed solution, there is broad industry support behind advancing a more limited version of the proposal that aligns with our views of proceeding in a data-driven, incremental fashion. The SEC could proceed with adjusting the tick size to a half a penny for only those stocks determined to be tick-constrained, then engage in further analysis based on the effectiveness of this change before determining whether additional changes are justified. This SEC's order competition proposal, on the other hand, introduces significant uncertainties and operational complexities that present heightened potential risks to market stability. While the potential impact to liquidity provision and execution quality are concerning, the operational complexities its mandated auctions would entail are hard to overstate. Given these factors, the order competition proposal presents a substantial risk to markets as an untested and experimental solution to an unproven problem. Finally, the SEC's best execution proposal would establish for the first time a commission-level best execution standard for broker-dealers. Best execution is not a new concept in the securities markets, and much of the proposal appears to be redundant and overlapping with existing obligations. Even if a problem did exist with the current best execution framework, the most effective way to handle any concerns in this space would be through the SEC's oversight of self-regulatory organizations and the implementation and enforcement of existing rules. Just as a doctor would never treat an undiagnosed patient, market structure changes should be approached with careful analysis and precision. Given the health of U.S. equity markets, the SEC should proceed thoughtfully and incrementally, focusing on empirical data to support any further regulatory action. Thank you for your attention, and I look forward to your questions and any further discussions on the topic.
Thank you, Mr. Rubenstein. Ms. Schack, you are now recognized for 5 minutes to give your oral remarks.
Chair Wagner, Ranking Member Sherman, honorable members of the subcommittee, good afternoon. Thank you for inviting me to testify. My name is Justin Schack, and I'm partner and head of market structure at Rosenblatt Securities. The views I express today are my own and not necessarily those of my partners or my firm. For nearly 3 decades, I've earned a living studying equity market structure. During that time, our markets have evolved dramatically. Before this transformation, the average person could easily understand how they functioned. Trading mostly was manual, slow, and inefficient. Member-owned marketplaces dominated trading, shunning improvements that could have bettered end-user outcomes. Investors paid bid-ask spreads as wide as 25 cents per share on actively traded stocks. Reforms during the late 1990s and early 2000s collapsed those spreads to as little as 1 penny and began to fragment trading across a wider array of competitive market centers. This proved painful for many intermediaries, but opened opportunities for others, all while putting more money in end investors' pockets. But the reforms also had vast unintended consequences. Wall Street responded to them in ways that policymakers did not anticipate, necessitating even more regulation. As a result of that long evolutionary cycle, the average person today cannot easily understand how markets work. They're highly automated, lightning fast, vastly fragmented, and extraordinarily complex. No one with a blank slate would design such a complex system to achieve such a simple task. But fortunately, today's markets are also far more efficient for end users. Commission rates for institutional and retail investors have come down steadily. Most retail trading is now commission-free. All-in costs for institutions are far lower, and investors can access troves of data to help them manage the agent-principal conflicts that are embedded in today's complex structure. Considering what I've learned analyzing this sea change, I believe policymakers should bear in mind 3 principles regarding market structure. First, the interests of asset owners and issuers should be paramount when making policy. Now, between those 2 groups of end users lies a vast array of intermediaries. They bear most of the burden of today's complexity, and they're typically the loudest voices in any policy debates. but middlemen are remarkably skilled at adjusting to new rules of the road and preserving their positions in our market ecosystem. Asset owners and issuers are usually among the quietest voices in policy debates. They have much at stake, but often are preoccupied with jobs, families, maximizing shareholder value. They're far less able than intermediaries to make lemonade from policy lemons. They need public servants to protect their interests. And recent history is filled with examples of reforms benefiting end users while forcing painful but successful evolution for middlemen. Second, despite the unintended consequences that I described earlier, end users receive excellent outcomes in today's market structure. But today's efficiencies were far from guaranteed. During the early 2000s, as the market adjusted to massive regulatory change, asset owner transaction costs rose for a time. Eventually, things got and stayed better, but this growing pains period is a cautionary example of how the unintended consequences of major reforms can harm asset owners and issuers. Third, and most important, policymakers should prove clear, significant harm to market end users before adopting major reforms. Now, let me be clear. Such a high threshold for action doesn't mean we should never undertake any reforms or question whether end user outcomes could be even better. Recently adopted amendments to Rule 605 of Reg NMS, for instance, will give retail investors a better view of execution quality without upending market practices and behavior. Carefully modifying our one-size-fits-all tick size regime would further reduce bid-ask spreads for many stocks, putting more money in asset owners' pockets with a minimum of disruption and unintended consequences. But not every cause for concern or inquiry crosses that threshold of clear harm to end users and justifies major reforms. Absent such evidence, new rules to discourage fragmentation and foster more multilateral interaction of trading interest on public markets, as contemplated under the proposed order competition rule and regulation best execution, risk doing more harm than good. Similar flaws plague the SEC's proposal to ban certain volume-based transaction fee incentives offered by exchanges. I fear this measure could make competition more difficult for smaller brokers and exchanges, counter to its stated intent, while potentially harming market quality for end users. Thank you again for inviting me to testify, and I look forward to answering your questions.
Thank you, Mr. Shack. Mr. Ramsey, you are now recognized for 5 minutes to give your oral remarks.
Thank you. And Chairman Wagner, Ranking Member Sherman, and other esteemed members of the subcommittee. My name is John Ramsey, and I am Chief Market Policy Officer at Investors Exchange, or IEX. IEX is a registered stock exchange founded on innovating in ways that promote transparency and fairness in stock trading, and most of all, that serve American investors. I will focus my remarks on the SEC's proposed changes to the set of rules called Regulation NMS, which the SEC adopted in 2005, nearly 20 years ago. Reg NMS sets the basic rules of the road for stock trading, covering things like the minimum price increments for displayed quotes and the prices investors must pay to access those quotes, among other things. The SEC has been considering modifications to these rules for many years, but its recent NMS proposals constitute the first comprehensive effort to update them since they were issued. The world of stock trading, like much else in the world, has changed dramatically since 2005. At that time, YouTube was brand new, the iPhone was 2 years away from being released, most trading on the New York Stock Exchange still occurred on a trading floor, and NASDAQ was not yet an exchange. Many people investing today may well have been in kindergarten when the rules were written. I'd like to briefly walk through each part of these proposed changes. The first is tick size. In 2005, the SEC set a common standard that markets could accept and display orders only in 1 cent increments. This made sense at the time since investors had no interest in trading at narrower increments. But today, much trading, a majority in fact, is concentrated in very high volume stocks which would quote at narrower prices but are constrained by the 1 cent tick standard. An overwhelming consensus of commenters endorsed one of the alternatives the SEC identified in its proposal, to adopt a new half-cent tick size for these high-volume stocks so participants can quote at prices where people want to trade. A second change involves fees to access exchange quotes. Reg NMS prohibited traders from trading through the price of displayed quotes, which gave exchanges unusual pricing power. Because the SEC did not want exchanges to use this power to charge a coercive toll on participants who often had to trade on exchange, it capped access fees at a level equal to the highest fees any markets were charging at that time. Today, most exchanges continue to charge this maximum fee, even though technology has made trading much more efficient, and markets without displayed quotes charge much less to access liquidity. As a result, investors are paying billions in excess toll fees, exactly what the SEC had tried to avoid. To address this problem, the Commission proposed to substantially reduce the access fee cap for all listed stocks to a level that better matches competitive market prices. This proposal, too, has received broad support, especially from asset managers and pension funds who hold many trillions of dollars for American investors. The other parts of the NMS reforms would increase transparency. One would require that exchanges set their transaction prices so the amount of the fee charged or rebate paid for a trade is known at the time of the trade, which, believe it or not, is usually not possible to know today. That would improve visibility and give investors a better ability to reclaim rebates that are paid out on their accounts. The other improvement would fast-track the implementation of changes ordered under Chairman Clayton's tenure. This relates to the fact that the best prices shown are almost always based on quotes for at least 100 shares, which is an age-old convention. But today, a majority of trades are in smaller odd lots. There are often better odd lot prices available, but average investors can't see them because the public data feeds are still using the old standard. The SEC is proposing to mandate that these better odd lot quotes be shown to everyone. These transparency improvements also have very broad support. And all of the changes I have described do not require more data or analysis. They all involve sensible updates to existing rules. They respond to what investors have said they want, and they build on years of study and debate. A big part of the reason the U.S. equity markets are the strongest in the world is that regulators have been vigilant about keeping regulation up to date and relevant. We respectfully submit that the Commission has all the data, input, and rationale to move forward with the changes I have described without delay. Thank you, and I look forward to your questions.
Thank you, Mr. Ramsey, and I thank all of our witnesses for their testimony. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. Professor Brogard, yesterday I and other Republican members of this subcommittee sent a letter to Chair Gensler requesting that the SEC delay finalizing any remaining equity market structure proposals until after the new Rule 605 amendments are fully implemented. This would allow the new Rule 605 data to be collected and properly analyzed. Considering the importance of our equity markets, do you, sir, agree with us that the SEC should base any equity market structure reforms on the most up-to-date and relevant market data?
Thank you for that question, Chair Wagner. Yes, I would wholeheartedly agree that we need accurate, up-to-date information to make informed decisions about what other market structure changes we may want to consider.
And considering that the tick size proposal, the best execution proposal, and the order competition proposal all reference old Rule 605 data in their economic analyses, do you believe that the new Rule 605 data will change the economic baseline of these rules?
Yes, I do. There's several changes to the new Rule 605 or amended 605 data that would enhance the cost-benefit analysis for these other proposed rules.
And what are the dangers of basing major reforms on stale, inadequate data?
I think you might end up with the wrong conclusion.
I couldn't agree more. Mr. Rubenstein, the SEC acknowledges in its best execution proposal that, if adopted, this regulation could actually result in increased costs and commissions for retail investors, when today these investors enjoy commission-free trading. Do you think it is in retail customers' best interest to pay more for services that they getting for free today?
Thank you, Chair Wagner, for that question. Absolutely not. We should strive and continue to strive to make investing democratic, inexpensive, and as accessible as possible to as many Americans as we can.
Mr. Kennedy, we can't help but notice a concerning trend involving Chair Gensler and the SEC. Under his leadership, the SEC will adopt a controversial, sweeping rulemaking. Industry groups will sue the SEC and challenge the rulemaking in court, and in several instances, the courts have struck down the rulemaking in question. These days, seemingly, each new adopted rulemaking triggers this series of events. In your opinion, has Chair Gensler done a disservice to the SEC as an institution by normalizing getting sued over and over again and losing, most of the time, yet again today in the Supreme Court, questionable rulemakings?
So I think they're doing their job in the way they know how, but they're not listening to us. They're not going through the same historic process that we've gone through for decades when we've made great changes through these markets. Everyone here today, Chairman Wagner, said we operate the best markets in the world, yet the SEC is not putting us in a position to sit back and make small incremental changes that are data-driven, where we can analyze the data. Instead, they're jumping ahead and getting to a result, and I think the heading of this panel is best. It is they're finding a solution for a problem that may not exist.
Thank you, Mr. Kennedy. Mr. Schack, one of the constant themes in your writings to the SEC is that the SEC appears to rely too much on theory and not enough on hard data as to practical benefits or costs. Do you believe at least certain elements of the SEC's equity market reform proposals rely on unproven expectations on how a rule might work?
Thank you. I should say first, I think, as Mr. Kennedy said, the people at the SEC are hardworking public servants. They're trying to get to the right answers, and I think they do a good job overall, but there definitely is some of that in the proposals that we're talking about today, and I think the volume-based transaction fee proposal is probably the best example of that. It envisions this world in which things will get better for smaller brokers competitively, they'll get better for smaller exchanges competitively, and I can envision some scenarios in which the exact opposite would happen. If you think about small brokers particularly, we're one of them. We access markets through larger brokers, and we do that for lots of reasons that have nothing to do with fees. We would continue to do that if the proposal went into effect, and we might actually come off worse for it if our pricing went up.
Thank you, Mr. Schack. The chair now recognizes the gentleman from New York, Mr. Meeks, for 5 minutes for questioning.
Thank you, Madam Chair. I want to thank each of our witnesses for being here today to discuss the SEC's equity market structure reforms. I believe that our capital markets are the envy of the world for a reason. They are highly liquid, efficient, and regulated. And as the industry modernizes, I believe that the duty of the SEC to consistently and prudently examine how the plumbing is working in order to identify reasonable updates and reforms. And as part of that, the public comment period is incredibly important too. So with that, last February, the SEC received a comment letter on its equity market structure proposals from the National Association of Security Professionals, whose purpose is to support increased opportunities for securities professionals of color and fair access to investors who have traditionally been shut out of the markets. In that letter, they say our initial concern is that the SEC's proposals could result in a lack of access to the stock market for underserved demographics, which could negatively impact the ability of these individuals and communities to build wealth and in turn further widen the existing diversity gap in investing. So first I'll turn to you, Professor Bogart, because you're the economist and academician. Based on your research, do you believe that the SEC's proposal could result in a lack of access to the stock market for underserved communities, especially those in communities of color? Because it's shown, some of this research, that more people in low and moderate incomes are now investing in the stock market.
Thank you for that question, Congressman Meeks. Yes, I agree that any change that increase the cost to investors can hurt the access to different groups, especially groups that may not historically have been a participant in the stock market.
And so do you have any recommendations of what you think Congress or the SEC can do to ensure that the new rules don't unintentionally harm minority and low-income investors, like people in my district?
Yes, I think at a high level, that the core that makes the U.S. stock market so great and the cost so low and it's so efficient is that it's highly competitive. It takes a couple of minutes to set up a Robinhood account and have a $0 transaction cost.
Now, let me jump to Mr. Ramsey, because it's my understanding, Mr. Ramsey, that there's broad support for a substantial reduction in the access fee cap, and that there's a difference of opinion, I know, however, in whether the reduction should be made proportionally to a reduction in tick size. So I want to know from you, how do you see the reduction in access fees improving the overall trading experience for institutional and retail investors, and what specific benefits do you believe they would see from this proposal? And then right after that, because I'm trying to get everything in, I'm going to go to Mr. Kennedy. And Mr. Kennedy, I understand that NASDAQ has a different take on the access fee debate than from Mr. Ramsey's firm, from what I understand. But I'm going to hear Mr. Ramsey say. And could you then elaborate on that position and explain why you believe the benefits outweigh the need for uniformity across the full spectrum? Mr. Ramsey first.
I will start first, and I suspect my colleague may disagree with some of what I say. And appreciate the question, Congressman. The point of reducing the access fee in part is that institutional investors in particular, when they trade on exchange, usually trade by seeking to access exchange quotes, not posting them. And what that means is they bear the brunt of the fact that exchanges charge this maximum fee now, which amounts to, again, billions of excess dollars in what I sort of called a toll fee. The idea that you should only reduce the access fee for certain stocks, more liquid stocks, we believe doesn't have much basis. And it also creates an odd circumstance where you would basically be saying participants
Don't want to cut you off.
Yeah.
I got to give some time to Mr. Kennedy. So Mr. Kennedy, you heard what he said right there. Go real quick.
I look at two stocks, Congressman. I look at a stock like Regeneron, a great NASDAQ-listed company in your district where it's $1,000. I don't need to reduce the access fee cap there because I want to reinvest the access fee cap into the NBBO, which ranking your colleague said the bid-ask spread matters, and I want to take that money, keep the access fee cap, maybe even in a stock like Regeneron, $1,000, maybe even increase it, and then use it in stocks like Paychex, where I can maybe lower the access fee cap. I just want to do it intelligently.
Thank you. Yield back.
Thank you. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair. At the end of December 2022, the SEC released 4 significant revisions in the U.S. equity market structure. While introduced as a package, each rule was only considered in a vacuum, absent of meaningful feedback from market participants and sufficient analysis. One proposal with deeply flawed cost-benefit analysis is the best execution rule, which would create an additional best execution standard on top of existing rules. Mr. Rubenstein, could you discuss why the SEC is proposing a best execution rule while FINRA and the MSRB each have rules already in effect?
Thank you, Congressman. I don't know why they're doing that because the best execution rules, best execution has been something that's been part of the fabric of the markets for a very long time, and it's FINRA and MSRB's responsibility to enforce that. And if there were issues there, the SEC could handle that by their oversight of those institutions rather than introducing potentially overlapping and confusing rules that will just cause a lot of costs for the industry that might get passed on to consumers.
Continuing with you, sir, if the Commission did reasonably identify an issue with the current best execution framework, could you explain how the SEC could go about addressing that?
Well, they could, I'm sorry, sir. Yeah, they would address that directly with the SROs and FINRA, and those policies, making sure that they were appropriate and enforced.
Professor Brogard, could you also share your perspective on the SEC's justification for the new best execution rule and how a new standard compares to what we have already?
Yes, of course, Congressman. We have the FINRA and the MSRB standard. They've been around for decades. There have been cases brought, in my understanding, by FINRA, by the SEC to enforce them. And I am unaware of widespread concerns about any gaps in the existing Best Ex rules. The SEC, to my understanding, does not currently have a Best Ex rule, and my reading of the proposal was this was their attempt to get one on the books.
The SEC has so far been uninterested in robust engagement with market participants and has not provided a forum for stakeholders to provide feedback that these substantial market structure changes should require. NASDAQ, along with a diverse set of market participants, has been outlining concerns with the market structure proposals, but the SEC is yet to change course. Mr. Kennedy, could you explain why it's important for the SEC to consider these proposals and what's at stake for retail investors if they don't?
I'm going to answer the second part of your question first,
Please.
which is what's at stake? What's at stake is widening spreads. Widening spreads, if they don't do these, if they don't move incrementally and look at the data and understand exactly what they've done, how can you go back and see what worked and what didn't work? And the key, paramount to us is the MBBO, because I think every person in their opening statement referred to the greatest markets in the world. They referred to the spread. Spreads will widen if we break something on the MBBO, and that will harm investors because they will pay more. They reach out and pay the offer, and they sell at the bid.
Mr. Rubenstein, in 2005, the SEC conducted a two-day roundtable with 7 panels prior to implementing the regulation NMS. How does the SEC's public engagement compare to the SEC's engagement in acting regulation NMS in 2005?
Thank you,
We have now compared to the way it was done in 2005.
Sure, thank you, Congressman. It barely compares. You know, our markets are the envy of the world because of a process that's data-driven, that's very done in a very purposeful manner. Taking all these proposals together and implementing them together is irresponsible. And even the way they were composed, you compose them by talking to stakeholders, identifying a problem, and then proposing a few solutions, whittling them down, and then having a rule, not having a rule and then having people debate it after you've already written the rule.
Madam Chair, I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the distinguished ranking member, Mr. Sherman, for 5 minutes for questions. Excuse me, Mr. Sherman. Mr. Kennedy, could you move your mic closer to your, thank you. We want to hear all your brilliant, up a little bit. All your brilliance, thank you.
So, Mr. Kennedy, I alluded in my opening statement to the situation where an exchange can have a technical glitch and investors can lose tens of millions and hundreds of millions of dollars. It happened with the Facebook offering over a decade ago. I like to understand how customers are made whole for the losses that they suffer when you have this glitch. Could you describe how the exchanges contribute to paying those investors when the glitch occurs under the current rules?
Absolutely. First, what we do, nothing is more important to us than the resiliency of the markets. And I think we all try not to take it for granted, but we at NASDAQ and our fellow exchanges that I'm representing today invest constantly in the resiliency, 24/7, teams working around the clock. But that said, Congressman, things happen. And we understand that those things happen. We have a very transparent rule set where we're able, through the SEC, to give back what we call accommodations when we are at fault to the best that we can. And we also will file...
If I can interrupt, you do have a $250,000 limit on your liability that was created by the exchanges themselves. I can understand why you couldn't have unlimited liability. You might go bankrupt. That would be terrible for the entire country. But it occurs to me that you should be able to get insurance that would cover more than $250,000. Because when I say $250,000, that isn't $250,000 per investor. That's $250,000 for everybody who bought Facebook. Could you get insurance that would allow you to have some limit that would be much higher than $250,000 for the whole country?
I would have to get that answer from my team, my legal team. I just don't know, and I don't want to suppose. But as you know, the markets are extremely intertwined, which is why we're here today, to talk about the interconnectivity of those markets.
I do want to move on to another question. Broker-dealers registered with the SEC and FINRA undergo examinations by both agencies, although FINRA's are more frequent. Presumably, if this best execution were adopted, SEC examiners would review broker-dealers for compliance with the SEC's best execution regulation, while FINRA examiners would be reviewing for FINRA Rule 5310, covering the same material. Professor Bograd, would broker-dealers be required to have separate compliance programs to meet these two different best execution obligations?
Thank you for that question, Ranking Member Sherman. I am not a compliance expert. The SEC's best execution rules seem to be stricter than FINRA's. It is unclear how the two organizations would deal with that conflict, given that FINRA is a SRO and SEC is a government regulator.
Should FINRA simply repeal their regulation and say, as long as you live with the SEC regulation, you're fine with us? Or should we have two separate regulations in that area?
I would think it would make more sense to have one uniform regulation.
Mr. Ramsey, we've seen this Supreme Court decision that creates a big federal jury case about every SEC enforcement effort. What effect is that going to have on the ability for us to rely on our capital markets being the envy of the world? And I realize you haven't had time to read the decision.
I have not, and I'm certain I'm not enough of a legal expert to give you a definitive answer. I would say that certainly the SEC has relied on ALJs for a lot of cases now. I think they have increasingly been relying on the courts. I'm sure there are cases where it would make their job more difficult and increase the burden of catching wrongdoing, but beyond that, it's hard for me to tell you how much of an impact it
And how
might
would
have.
allow trading in sub-penny increments benefit retail investors in pension funds?
Yes, I think that's very critical. And I note that several of my colleagues, even though they said that they were concerned about not moving ahead, suggested that moving ahead to half-cent ticks could be helpful. The important thing is that it means that prices can then trade where people want to trade, and that means that the bid-offer spread, which is so important because it defines every other pricing metric that people use in the market, it means that those prices more accurately reflect the prices that investors can then get. So it's basically more money in the pockets of investors because the prices that define what they can actually achieve are better.
Gentleman's time's expired. The chair now recognizes the gentleman from Texas, Mr. Sessions.
Madam Chairman,
5
thank you
minutes.
very much. Mr. Rubenstein, I'm going to push my remarks to you, so want to give you a heads up. Our young chairwoman, when she began, wanting to talk about market retail investors facing problems. One of those is directly what this hearing is centered on, and that is regarding tick sizes. And GTS, Global Trading Systems, has a letter to the SEC advocates for studying data and processing incrementally with a proposal as data is collected rather than relying on a theory. We sent, many of us on this committee and subcommittee, sent a letter to the SEC that's probably dated perhaps yesterday to perhaps today. Page 2 of that letter said, if adopted, referring to the proposal that the SEC has, in its current form would induce significant and unwarranted complexity in today's efficient market structure that could increase operational risk and create investor confusion, undermining our constituents' confidence and ability to participate in equity markets. It also would limit investors' opportunities for price improvement by mandating the trading increment at which stocks trade. My real question to you is, what more do we need to say to the SEC? It seems like that the market-based people have provided their feedback. It seems like that we as members of Congress have provided this. We are here asking you, and our chairman did, how can we make sure that the retail investors facing problems have fewer of these problems? What more do we need to do with the SEC? Because we struggle with them.
Thank you, Congressman. Well, I would agree. I mean, the retail investor experience has never been better, and a lot of the folks up here, have echoed the same. Let's go back to the last time the SEC was messing with tick sizes. They wanted to widen ticks 10 years ago. Now they want to narrow the ticks. And then 10 years ago, there were folks who thought that that wasn't a good idea, folks who thought that that was a good idea. They were trying to increase the amount of liquidity that's visible at every price point. So let's see what happened. They had a pilot, which was great, a nice, slow experiment with the markets. They analyzed the data and turned out they were wrong, that it actually made trading worse. And it cost the industry a fortune to comply with the rule. And they actually figured out that retail investors lost money because of the pilot, which might or might be a good idea because they were trying to see if there was a better way. So if we're going to mess with tick sizes again, we need to really identify what the problem is, what are we trying to resolve, and then be more prescriptive with the solution, and certainly do it in a careful way that we can analyze data after.
I find that when the SEC and perhaps others in government agencies get involved, it adds cost, time, complexity, money. This is what I think is a big part of the retail investor problem: complexity, rules, regulations, timing, who sends what to who when. These are all things which I think our chairman and these committee members are concerned about. We don't want to make it simple. We want to make it straightforward. Does anybody else on this panel have any ideas about that? Because we're struggling with this SEC. No? Okay. Well, Mr. Rubenstein, I have passed to your team today some questions that are directly related to this issue, to the issue of working with and understanding not just government, but the procedures. And I wanted you to be aware, probably when you get back to the office, you're going to find out somebody saying, can you please help us out with some of these issues? Because we think you're positioned in a way to see things from a perspective, and I appreciate your response. Your team has indicated they will respond, but I appreciate that. And I want to thank you for being here today. Madam Chairman, I yield back my time.
Gentleman from Texas yields back, and the chair appreciates being referenced by the gentleman from Texas as young. And the chair now is happy to recognize the gentleman from Georgia, our birthday boy, Mr. Scott, for 5 minutes.
Well, thank you, Chair Lady Wagner, and let me compliment you. This is an extraordinarily important hearing. Our high technology and artificial intelligence is moving at warp speed, and nowhere greater do we need to examine this as in terms of wealth building and our investors. So I want to discuss this Rule 605. And today, let me address this to you, Mr. Ramsey. We're moving at warp speed, but back in 2002, the number of available trading venues included only 9 registered exchanges. And today, just 22 years later, we got 16 exchanges, 33 automated trading systems, and more than 220 other venues where orders can be executed. And this is showing just how fast our equity markets are evolving, but we're not keeping at it. So I want to talk about this Rule 605, see how we can quality examine these executions. What is the likelihood, Mr. Ramsey, that retail investors will take the time and, first of all, even understand and review and take actions on this data provided in the reports with these recent changes?
I appreciate the question, Congressman Scott. And I'd like to make a point about Rule 605 because I think there's a misperception about that. Rule 605 was never designed for the purpose of generating data that would then determine whether any other market structure changes need to be made. As you rightly point out, retail investors are not going to be reading those reports. It's unlikely that many would be reading them. They'll be relying on other people and intermediaries to read the report and make comparisons among different brokers. Appropriate that they do that. But in terms of, don't we need to look at 605 reports and wait for 5 more years to figure out whether we reduce tick size or we reduce access fees or do the other things that I've mentioned? We have all, respectfully, Congressman, we have all the data we need to make those decisions. These were issues when I was at the commission that were actively talked about and researched, and that's been over 10 years ago. And at some point, this argument that we've got to have more study and data just sounds like code for don't make any changes that are likely to disrupt my business. And while I understand that sentiment, it doesn't seem like a good regulatory policy.
And Mr. Ramsey, I'm really fascinated with this rapidly growing impact of artificial intelligence. So, Mr. Ramsey, what do you see as the biggest influences on the electronic trading landscape right now? And just how is this adoption of artificial intelligence now impacting our equity markets?
Thank you, Congressman. Obviously, artificial intelligence is affecting all kinds of different areas of our economy now. I would tell you, I am not an expert on AI. From the people who know a lot more than I do that I've talked to, it seems like it is being used in some ways, generally minor ways, experimental ways, in aspects of trading today. It does not seem that it is taken over trading, but I do think that there are legitimate concerns about how AI is used, that it's managed appropriately, and I think regulators need to be attuned to that.
Yeah, because if we're not careful, we're going to become the servants of the machine, artificial intelligence, that was created to serve us. We got to be careful about this, particularly when it comes to handling finance and equity building. Thank you, Mr. Chairman.
Gentleman yields back, and the chair now recognizes the gentleman from Michigan, Mr. Huizinga, who is also the chair of the Subcommittee on Oversight and Investigations, for 5 minutes for questions.
Thank you, Madam Chair. I appreciate it. I'm going to start just with a thank you, Mr. Rubenstein, your op-ed that you wrote about the impact, the potential impact of a China invasion of Taiwan, and you highlighted a number of potential catastrophic things that might happen, and I just want to encourage all of my committee members to take a look at that, and if we have time, I'd love to revisit that. But I want to talk to you a little bit about the SEC. Courts have weighed in, again, a couple of times They continue to get hammered for the decisions that they're making, and it just seems to me that we're back in this hamster wheel of decision-making coming out of the SEC. And I want to talk a little bit about the auction process. The information about unexecuted retail orders, including information about the security, size of the order, side, buy, sell, or sell short, price, originating broker via auction announcements that those firms are free to trade in front of or against. Do you agree that this auction process would essentially make all retail orders, quote-unquote, flash orders, which is something the SEC proposed banning in 2009?
Thank you, Congressman. I would agree that there would be disclosure of information that markets and investors aren't used to navigating, and the effects could be deleterious, certainly for the retail investor.
Do you think it would be good for investors? I mean, this is something that, again, the SEC was kicking around banning in 2009.
It would not be good for investors.
Okay, and I seem to recall that. I think that's one of the major tenets of the SEC is to investor protection. I think I might have to go back and check my notes on that one, but I'd encourage them to go back and check their notes on that, that and their constitutional lane that they have to actually operate in, because the courts have been slapping them down on a regular basis. Professor Brogard, as you know, payment for order flow information is publicly available and is subject to scrutiny by FINRA and the SEC. If there were glaring cases of misconduct or examples of market participants ignoring best execution obligations, then presumably we would have seen enforcement actions on that front, correct? And my understanding is that that's not the case.
That is correct. The payment for order flow information is currently required to be disclosed, and I couldn't tell you of an instance where there's been an action based off the payment for order flow.
And is there any academic research to say that payment for order flow is hurting or isn't hurting the average retail investor?
There's a reasonable amount of research on payment for order flow, and I would say the overwhelming consensus is it is positive to at worst neutral for the end investor.
Okay, sounds like protecting the investor again. All right, would you explain why certain research demonstrates the current process where wholesalers pay broker-dealers for trade actually may help those investors?
I'll try to do that in a minute and 30 seconds.
Or less, since I've got one more question, but go ahead.
Okay, yes, I think it's specialization. Wholesalers are experts at what they do, and what they do is take retail orders and search for the best available price along with other characteristics that are important to retail investors and help brokers execute those trades.
Okay, well done on that, by the way. Mr. Kennedy, my colleagues have brought up tick size and talked a little bit about that. The SEC's proposal estimated over half of NMS securities are tick constrained. I'd love for you to expound on what in the hell is a tick constraint? And then by contrast, SIBO concluded that 67 symbols out of their 10,125 securities actually were tick constrained, whatever that might mean. So take a few moments and illuminate us, please.
So in 39 seconds, what I will do is I'll tell you tick constrained is no place left for price improvement. So 8 cents bid offered at 9 cents. Where do you trade? So this is why we support some evolution there. But back to what the SIBO does, I can't really speak to that, but I think the important thing to do is if they think there are 67 tick constrained stocks and the SEC thinks there are thousands, this is exactly why we need more public disclosure and more comments to get to why we're here today.
Yeah, well, and NASDAQ's comment letter also notes that the Commission's own analysis of the tick size pilot does not support the conclusions drawn in the proposal. So my time is up, but it seems to me we need uniform definitions and determination to move ahead, and that is not what's happening. So with that, I yield back, Madam
Gentleman
Chair.
yields back. The chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes for question.
Thank you very much, Madam Chair and Ranking Member. I think the hearing today has been excellent, as it was yesterday when we talked about the stress test the Fed gives. One of the issues there was, how much should they disclose and what they didn't disclose, the stress test, and whether after they take the stress test, these banks, whether they then should disclose what the test was. And I'm not sure about the first part. I think there was lots of disagreement, but the second part, certainly you ought to be able to see the stress test. And here, Mr. Kennedy, you just talked about data too, and that you should have more information. I agree with that. I mean, I do agree. So this part of the data I think is important for me. A couple of you have had the chance today to talk about free trades. The trades are free. And no one took the bait. Said trades are inexpensive. Are they free? Anyone like to comment on that? Yes, Mr. Kennedy, go ahead. You can.
Sure, I didn't know if you're asking someone.
Well, I can ask, it's to anybody.
Commissions are free. I wouldn't say trades are free. I'd answer the question as commissions are free. But again, going back to the real cost, and I think the ranking member brought this up, it's spreads.
The spreads,
It's
right.
all about spreads. And the more that you lower the access fee cap, the less the exchanges have to put back into the spread. So what will happen is the access fee cap will drop. We won't have the same resources to supply rebates and economic incentives to market makers, and spreads will widen. And that will be the real cost to investors.
Yeah, and there is the cost. I mean, that's the part I think that's important. There is a cost, right? Am I wrong about that? There is a cost to invest. Would anyone disagree with that? No?
Spreads are the cost.
I'm sorry, go ahead.
Specifically, Congressman, with respect to the access fees, I would say that that the argument that exchanges need these access fees in order to pay out rebates is sort of conjecture. But the point is that firms like Vanguard Capital Group, Invesco, JP Morgan, XTX, et cetera, who have all argued for a uniform significant reduction in the access fee. It's not that they don't understand the arguments that are made about liquidity, they just don't believe them. And those are people that are unconflicted because the only people that they really care about are ultimately their beneficial owners and whether the markets work well for them.
Okay. Another issue that came up was very interesting. None of you took the bait when it came to the SEC itself. In fact, you went out of your way to say, oh, they're hardworking public servants, they're great people. I believe that too. So why haven't you had the ability to work closer with them on these changes? Because I do understand. I mean, like yesterday, I think we have an excellent panel here who seem very reasonable to me. Why hasn't that been the case? Or can that be the case? Mr. Kennedy, you shake your head the most. Well, I'm going to go to you, sir.
We can. We absolutely can. That's what we want to happen. We've been out public on every single part of this. This is a large endeavor, and we want to walk through it with them. They are exceptional, but we want to do it incrementally.
Okay. And the reason I say this is I do think, and you, it might have been actually Mr. Kennedy yourself, who noticed how more and more we're getting more and more efficient, it's better, more people are coming into the market, and I think that's a very good thing from a public policy perspective, because when people retire now, unfortunately, they don't have the retirement that they used to have, the pensions, in the same way. Now, instead, they rely on the market, and so we should have the most efficient market possible for them. The companies don't do this, so more and more it's the market, so I think this is important, and I appreciate that, and I wish that we could get you guys together. Lastly, I do have to ask this because I ask every panel, how many of you believe in climate change? Okay, I appreciate that. When I started 10 years ago, about 2 people would. It depends on who called people up. Now it's pretty unanimous. With that, Madam Chair, again, I hope that the SEC can get together, and I do think that they may be moving a little bit too fast to see if you can't get to some agreements. Some more information I think would be important, as we heard yesterday. And again, this has been a very good hearing. With that, I yield back. Thank you, Madam Chair.
Gentleman yields back. The chair now recognizes the gentleman from Arkansas, Mr. Hill, who's the chair of the Subcommittee on Digital Assets and Financial Technology, for 5 minutes.
Thank you, Chair Wagner. Appreciate the opportunity to participate in this panel. Thank all of you for lending your expertise on what is a very important topic, but a very complex one if you're out there trying to follow this conversation. And because it is complicated, it could lead to uncertainty depending on how these rules are implemented and if they're implemented all at one time, which is why I've said from the very beginning we should get the Rule 605 data about equity market structure first, get it thoroughly vetted, make sure we have consensus around that. Because it's the first time since 2000, so 24 years that we have a new primary tool for measuring the quality of order executions across the market. And think how complex the markets are today in terms of venue of order execution than they were back in 2000. So this data is critical, I think, to the commission making a sensible decision. And I share Commissioner Peirce's concerns that the rule not only affects the baseline proposed rules, but also the data. So I think we need to start first by looking at the data. I think it's negligent, really, to go forward with all 4 rules simultaneously being implemented without that kind of clarity around the data. We've waited 24 years for an improvement in this tool, and we have it, so let's use it. And therefore, I think these rules are very much the cart before the horse. Congressman Foster of Illinois, my friend on the other side of the aisle, and I share that view, and we wrote the Commission Chairman Gensler last September, 16 Democrats, 16 Republicans, saying, let's get a handle on the data, report it, check the transparency, look at how these market structure reforms would interact with each other before we move forward. And I was pleased to sign Chairman Wagner's letter with the same point. So first, let me ask each of you this question. Do you think the Commission should prioritize updating and leveraging the best available 605 data, plus getting thorough input from market participants before moving forward with these market structure reform proposals? Let's start, Professor, with you. Just yes or no. Should they get the data from 605 and vet it and have input from the public thoroughly before these are implemented? Yes or no?
Yes to both.
Sir?
Yes, yes.
Ari?
Yes to both.
Sorry, I'll give you a more complicated answer. I don't think that's necessary for tick size reform. I also think the other 2, order competition rule and Best X, shouldn't go forward anyway because
At
the
all, pretty
SEC
good.
has
Okay,
it
that's
in its
fine.
case.
We take complicated answers. That's okay. Yes, sir.
Congressman, as I indicated, I don't think that 605 data is needed to make intelligent decisions about tick size and access fees and the other aspects of the Reg NMS reform.
Well, we've got some distinctions there, some nuance. I think that's helpful. But what do you think, Mr. Ramsey, about I don't hear any consensus, for example, that payment for order flow, the elimination of it, is good for retail investors. You're arguing apparently it is, huh?
Respectfully, Congressman, I haven't offered a view about payment for order flow.
Well, it's one of the proposals here. We're either for the proposals or we're not against it. Are you
so
for
I'm
that one going forward?
Congressman, I'm specifically speaking to the Reg NMS proposals.
Okay.
I think that payment for order flow remains controversial. I think regulators have been clear that it can create conflicts of interest,
Yep.
And that people need to be attentive to that.
Yeah, well, I think people are attentive to that. I think that's what the rules are about. That's what FINRA's job is. That's what the SEC job is, in my opinion. Mr. Kennedy, would retail investors at the margin be hurt by the removal? And I'm not an advocate here. I'm just asking questions. I'm doing my oversight job. Or would retail investors at the margin be hurt by removal of payment for order flow?
I'd be loath to say that we should change something right now because as we've discussed for the last hour or so, things are extremely complicated. So
Right. So we've determined this is complicated. We don't have all the data, although some would acknowledge the data is not necessary for a couple of the rules. I'll accept that point of view. And that they do interact with each other, and they all affect retail investors. And we're taking a Silicon Valley view here over at the SEC. Let's move fast and break stuff. Well, that's not what we do at the SEC or FINRA. We're not running a hedge fund over at SEC. We're protecting investors and having orderly markets. I think these are in the wrong direction. I yield back.
Gentleman yields back. I'm tempted to gavel at that point, sir, but we'll continue on briefly here. Remember the time. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair. Thanks to all the witnesses. You know, I appreciate that you all aren't intimidated by sitting before this committee, because, you know, Hollywood came here years ago and looked at the charm and beauty and intellectual giants on this committee and charisma and said, we should make a movie about you all. And that, of course, became Dumb Money and the story about Roaring Kitty and payment for order flow. So we're normal people, in spite of all our celebrity. Partly it just makes me laugh. I watched that trailer and thought, holy smokes, that was the hearing we had. But also because I want to dig into this payment for order flow a little bit issue, and I want to focus on you, Mr. Shack, because I think you said in an interview recently that under payment for order flow, brokers face a choice, rebates for themselves or price improvement for their customers, and it's obvious what's in the customer's best interest. Mr. Rubenstein, I think, had suggested earlier, and I don't want to misquote you, that these rules essentially are already in law, and this is redundant with existing rules. But my understanding is that the current rules require you to disclose, either when you open an account or if a customer requests, that you have a PFOF agreement, but doesn't actually require you to disclose whether that's a best execution. Do you want to just elaborate on how, Mr. Shack, how the new rules differ from the existing standard, to clarify that point?
I'm not sure I completely understand what you mean by the new rules regarding payment for order flow, sir. I'm sorry.
So the new proposed rules, my understanding is that those don't just require you to disclose that you have a PFOF agreement, but also have to document how that is consistent with a best ex obligation.
Yes, I believe it's regulation best execution that would require brokers who accept payment for order flow to jump through additional hoops when they're executing orders subject to that payment.
So when in Mr. Huizenga's exchange with Mr. Bogard, when he said there's been no enforcement actions of violation, the only rule that people could have violated is if they failed to disclose that they had an agreement, not that they failed to disclose that they were actually meeting best executions, correct?
I'm not expert enough on how that rule has been or could be enforced to give you a definitive answer to that question. I know there have been many enforcement actions brought throughout the years on retail execution. Whether they pertain to payment for order flow or not, I'm sorry, I don't have that at my fingertips.
Okay. Well, I mean, I asked this because when we were having those hearings about GameStop and Roaring Kitty and all the rest of that, we had Robinhood in here, and Robinhood told us that 100% of their options trades were routed to brokers that they had PFOF agreements with. And they were not in violation of those rules because they disclosed that they had the agreement. But I've never quite understood how the failure to send any trade to anybody you don't have a PFOF agreement with can ever satisfy that you knew that that was the best execution. Would you agree with that?
Yeah, I mean, I think the existence of payment for order flow in and of itself is not evidence of not achieving best execution. I think, as some of the other witnesses have said, first of all, what I'd say is that not every broker accepts payment for order flow. I happen to be a customer of one of those brokers, so I don't trade very often, but when I do, my broker does not receive payment for order flow. The other thing I would say is that even if there is payment for order flow involved, the wholesalers that make those payments to the brokers usually provide a better price than the quoted bid-ask spread, sometimes significantly so. Is it a perfect system? I don't know. Could things be better? Sure, I'm willing to explore that always, but I just don't think there's enough evidence out there that end investors or end users of the markets are being harmed by this enough to justify a wholesale rewriting of the market structure.
Okay, and when you say usually, I'm certainly not suggesting that all PFOF is bad, but the new best X rules would simply require that you demonstrate why in this particular case that was an advantage, right?
It's my understanding, and particularly from talking to other market participants, we don't handle retail orders, but in talking to those who do, I am under the impression that some of those brokers would have to substantially change their business models. Right now, retail brokers essentially use wholesalers as an easy button. They outsource execution. They would have to take on board a lot of those capabilities, which are quite expensive to maintain, and requiring them to do that could have, as I talked about in my written testimony, my oral testimony, unintended consequences that may differ from the way people think they're going to work out.
Okay. I'm about out of time. Yield back. Thank you.
Gentleman yields back. Chair recognizes the gentleman from Wisconsin, Mr. Stile, for 5 minutes.
Thank you very much, Ms. Chair. Mr. Kennedy, I'm going to start with you. I'm going to actually follow up to where the previous conversation was, because I think a lot of retail investors benefit from the market structure in place today. Low, no commission trades and quality execution become standard across platforms. For me, it's a little bit hard to see a case for the sweeping, disruptive regulatory overhaul that could harm retail investors. In NASDAQ's comment letter to the SEC, it included the following quote: "In certain cases, such as access fee caps, tick sizes, and order competition, the specific means that the SEC proposes to achieve its objectives need to be recalibrated to avoid collateral harm to markets and to investors." Briefly, can you just explain what that collateral damage is?
Yeah, thank you. One of the things that is, again, just paramount to the way we looked at all of these changes were what will it do to the MBBO? Because I think we've all agreed the spread is the cost. It's not the zero commission. It is the spread. And if the spread changes, that's where the cost to investors are. We have incredible momentum with retail investors right now. The education and the democratization has never been better. And if we don't move incrementally and understand the data-driven approach, review the data, get continued feedback, we will break something.
Thank you. So to follow up, Professor Brogard, if I can, speaking of the collateral harm to investors, some of the feedback you provided in a comment letter when you weighed in on the SEC best execution and order competition rules proposal, you wrote, quote, "The SEC's economic analysis fails to consider the underlying reasons why the current market structure performs as well as it does for retail investors, and that the significant likelihood that drastically altering the current structure will result in worse, not better, execution quality." Question: what is it about the current market structure that benefits retail investors, and how would the proposal endanger that? If you could just comment on that very briefly.
Thank you for the question, Congressman Steele. I would say that retail investors are benefiting from a high degree of competition. They have over a dozen exchanges to trade at, 30+ ATSs to trade at. It's a highly competitive market.
Perfect. So highly competitive market, it makes it attractive in particular for people to list on NASDAQ and other U.S. exchanges. Come back to you if I can, Mr. Kennedy. It's a competitive market, and it shouldn't be taken for granted that the United States will always be a world leader for listings globally. And so in particular, having that competitive market that Professor Bogart just talked about, does the SEC proposal put our competitive position at risk in your opinion?
In my opinion, yes, it does, because when you make these changes that cause uncertainty, we know that markets, A, don't like uncertainty, and B, corporate issuers that we deal with in and out every day, they want a stable price to be able to raise capital in their own issues.
I think that's a really important point here as we look at global competitiveness. The concerns that the SEC would put us at a global disadvantage or not allow us to maintain our market-leading position is something that this committee should spend time thinking about. I want to shift gears pretty significantly here, if I can, with you, Mr. Rubenstein. Talk about the geopolitical risks to our markets. You wrote a really interesting op-ed in May titled, "Are the Markets Ready If China Invades Taiwan?" I thought it was a quite interesting article. In the piece, you talked about the risk to our markets posed by Chinese aggression towards Taiwan. You looked at what companies and investors can do to minimize their exposure to such a risk. You noted that the federal government may need to act. Can you in particular lay out what you think the federal government should be doing to enhance market resilience in a dangerous geopolitical world?
Thank you, Congressman. The topic today is problems and solutions. And on the morning that Russia invaded Ukraine, we were responsible for opening a third of the New York Stock Exchange and tens of thousands of securities. And what was confusing to us is we didn't know if we could trade some of these securities, the interconnectedness of the markets. A lot of these securities are part of ETFs now, and it was very complicated. China and the U.S. Trade together 77 times more than the Russia and U.S. And that morning, the markets went down a few
significantly more.
Significantly more. So there isn't a lot of dialogue between government and industry, specifically the financial industry, about where bright lines would be and how we need to manage all that volatility. And fortunately, there is a bill that Representative Lukemeyer and Torres put forward that would put that responsibility to MSOC to create a advisory committee.
In summary, we should be looking at it.
We should be looking at that. That's far more important than all of the rules.
Cognizant of the time, I'm going to yield back. Thank you.
Thank you. Gentleman yields back. Chair now recognizes the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Chair Wagner. Thank you, Ranking Member Sherman. Very glad to see you as part of the Seersucker Caucus today. And to our witnesses, thanks so much. I'm very concerned about Gary Gensler's proposed equity market structure rules. They could dramatically change how the stock market functions and jeopardize commission-free trading that working families rely on to save for their retirement. I'm very concerned about any proposals that would increase the cost of retirement for my constituents. I join many of my colleagues in signing Congressman Foster and Congressman Hill's letter to Chair Gensler expressing concern about the SEC's approach to the equity market structure proposals. We point out that Rule 605 requires data to be collected on how well trades are executed, which the SEC itself has admitted needs to be updated. However, the Commission partially relied on this faulty data to justify its regulation best execution proposal. Given the recent updates to Rule 605, which I support, that aim to enhance the data collected by broker-dealers, I believe it's imperative that the SEC refrain from making hasty decisions until the new data is available to assess the necessity of their best execution rule. Our bipartisan letter stated this, and I hope that Chair Gensler takes this seriously. Professor Brogard, first question to you. Do you agree that the SEC should reassess the conclusions about execution quality made in the proposal to adopt regulation best execution after it has access to the updated and expanded Rule 605 data?
Yes, I do.
Mr. Brogard, you're an expert on best execution. Some say that this new SEC proposal is necessary, and others say it will actually lead to worse outcomes for retail investors. Can you please briefly summarize what you found in your study about whether the proposed rule is necessary and would be a net positive or net negative for retail investors?
Yes, of course. The sum takeaway is, based on my analysis, it would be a net negative for investors. The high-level reasons for that are that right now we have wholesalers who are highly efficient and compete against each other to take retail orders and route them to the best execution. And with the new best execution proposal, the ability for brokers to rely on wholesalers is called into question.
Thanks. And we're heading off to votes here. So last question to you, Mr. Rubenstein. We had a National Security Subcommittee hearing earlier today in this room on competition with China as we consider both the incredible strength of our capital markets and the ever-changing global challenges they face. What do you believe is the #1 threat to our capital markets today, and what changes or reforms do you recommend to enhance market resiliency and address these challenges?
Thank you, Congressman. Well, we certainly shouldn't do anything that would harm the markets and implement a lot of proposals, experimental proposals, all at once, and that's been a big topic. But separately, there needs to be a lot of dialogue between government and people in the markets responsible for the markets on how we would react to big geopolitical events like what we talked about if there was an invasion of Taiwan and the markets moved very, very precipitously. And that dialogue hasn't been happening, and I hope it starts happening so that we can all be prepared and make sure that the impacts are as muted as possible.
Thanks. Madam Chair, Mr. Chair, in the interest of having everyone make it back for votes, I yield back.
Appreciate that. Gentleman yields. I now recognize myself for 5 minutes. Thank you all very much for being here this afternoon. Yes, Mr. Chairman. The SEC, under its current leadership, many believe prioritizes ideological goals over industry-informed regulations that truly serve the needs of investors and other stakeholders in financial markets. It seems to make sense for a U.S. regulatory framework that would align with the realities of modern finance and not hinder our nation's ability to innovate and lead. That's why comment periods are essential, to hear feedback from the public and to be more informed about our markets. The SEC rules we're examining, rather than fortifying our markets, appear to undermine them by introducing complexities before gathering the relevant market data. This committee has emphasized again and again and again how short comment periods and rapid rulemaking do, in fact, push activities off our exchanges or unnecessarily constrain market dynamics. So, Mr. Kennedy, in December, I led a letter along with other Republicans on the subcommittee opposing the SEC's volume-based pricing prohibition rule. The SEC claimed this rule would somehow encourage competition on the exchange. I can't follow that logic. Do you think this would happen, or would the rule minimize competition, forcing activity off the exchanges?
Banning volume tiers, which are ubiquitous in our economy, is just counterintuitive to me. I don't get it. It will not help our markets in any way, shape, or form. Mr. Schack has already addressed in his comments how mid-tier brokers, small brokers benefit from the complete services that are offered from volume tiers. It's not just pricing. It's never been about pricing. And I think what you'll see is if volume tiers were to dissipate, the cost would just go up for investors, again, widening the MBBO.
And perhaps particularly on exchanges competition on the international basis. Would you agree?
Yes, I agree.
Okay. So, Professor Braggard, yesterday I led a letter to the SEC urging the withdrawal and reproposing of the tick size rule. We did discuss much of this earlier. Tick size is below a penny for volume-constrained stocks. Just if you could elaborate a little bit more, why is this important for this rule to be withdrawn and reproposed?
Yes, thank you, Congressman. Getting the tick size right is important because it sets a lot of how the market dynamics play out. We've had penny tick sizes for 23 years or so. I don't think they're, in the academic literature, smaller tick sizes are generally better, but there's a limit, there's an optimal, and you can have too small of a tick size, which leads to other complications. The SEC's proposal seems to be moving too fast, too soon.
Very good, thank you, I agree. Mr. Rubenstein, the SEC best execution rule, FINRA already has a best execution rule. Should the SEC, in your view, create its own rule, or should they work with FINRA to improve the existing rule if they identified problems?
They should not create their own rule. They should work with FINRA and MSRB to help modify their existing rules.
Very good, thanks. Mr. Kennedy, does this SEC have a history of providing adequate comment period or acknowledging the majority views of commentators and industry stakeholders when finalizing controversial rules?
They do have a history of doing that, to my knowledge. I've been in this business, this is my 38th year. I've seen in the past, whether it was NMS or even before that, the original circuit breakers out of the '87 crash, much more comment period, much more interaction, much more collaboration, public debate. I'm not seeing it here.
In the past, okay, all right, thank you. And finally, Mr. Braggard, recently in another one of our SEC oversight hearings, I asked David Burton from the Heritage Foundation how helpful the SEC has been to capital markets. And he replied a 0 out of 10, but he added, if they did focus on the right issues, it could be a 10 out of 10. So considering the current success of our equity markets and the drastic improvements to retail trading, is overhauling our equity markets work the right issue for the SEC to be focused on?
I think the intent of the SEC is good, but I think the focus is wrong. I think the retail experience right now is the best it's ever been. It doesn't mean it can't be better, but the area for improvement to me seems to be disclosure and information regarding EDGAR and simplicity, not market microstructure rules.
Great, thank you very much. And I yield back. Now we will going to close this hearing. We would like to thank our witnesses very, very much for your time and insights and overall testimony. So without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.